All right, so we're a couple minutes past, so we will jump in and get started on today's webinar. So, hello everyone. Thank you so much for taking some time out of your day today to join us here on our presentation. Just to introduce myself, my name is Jonathan Brandeo, and I am the Director of Learning and Development here at MLB. And today we have the pleasure of presenting a webinar on our remarkable down payment assistance program. What we're going to be doing is we're going to be taking a look at what the program is, how does it work, what borrowers it works the best for, and all the little things you need to know on how to properly structure it, how it's going to work on the back end, and what kind of pieces come into play when working on this specific down payment assistance program. Of course, if you have any questions as I'm making my way through our presentation today, feel free to throw those questions into the chat box that is here in Zoom. If I don't answer those questions right away, I'll circle back around to them. I always leave a little extra time at the end of our presentation as well, so that way, if you have questions, we can answer those at the end of the presentation too. And of course, as always, if you have any questions that pop in your brain, because of course that happens, if something pops in your brain after we're done today, reach out to your assigned account executive. They'll be able to point you in the right direction, let you know any answers to the questions about this program, and of course, anything else when it comes to your partnership here with MLB. So let's jump into things and talk about the remarkable DPA. So the Remarkable DPA, I love talking about this program because it's an awesome opportunity to have, as I like to say, the two different things I always use with this is your toolkit and your back pocket. Having this program available for those borrowers that need that extra assistance, those borrowers that it fits for. This is one of those programs that maybe doesn't fit for every single borrower that comes across your desk or is but these are one of those programs that you can go ahead and say, okay, uh, that borrower needs a little extra assistance. They're qualified for an FHA loan. We're going to move forward with this. And okay, now we can get that little bit of extra help. And the great thing about this, as I mentioned, already FHA, but the great thing is it's a completely forgivable grant from day one. And they have the option of choosing between a 2% grant or a 3.5% grant. So just as that entails, FHA requires 3.5% down. So in that case, if they go with the 3.5, there you go, covers the entire down payment requirement on an FHA purchase. So the borrower, all they need is their closing costs. And when it comes to that, then you can get still up to 6% seller concessions as well. So if you structure this in a way that they're getting that down payment assistance and then they're getting the full amount of seller concessions that they can get, there are ways to structure this that the borrower's bringing little to nothing to the table if this program works for them specifically. Now, as I mentioned, since this is a completely forgivable grant, there are no additional liens, there are no resale restrictions. Most the majority, I would say, majority of DPAs across the entire country require the borrower to have some additional lien on the property. They require the borrower to live in the home for, let's say, 5 years. It has additional rates. It has a third-party vendor they have to pay a separate payment to outside of their traditional mortgage payment. This program is not like that. It's a grant, a gift basically, given right there at the closing table, the same or similar, I would say, to if they had a parent give them money that goes towards their down payment. It works in that same type of principle that the borrower is never expected to pay anything back at any point. It is just money given to them as a way to assist them in purchasing that home through FHA. It is available for both broker and non-delegated correspondent as well. So whether you're signed up with us under one of those or both of those partnerships, you have the ability to deliver those FHA remarkable DPA loans to us, either broker or non-delegated correspondent. So those are kind of the basics there. Now, of course, one of the questions are going to be, what would be the difference of why someone would pick the 2% if they can go with the full 3.5%? There are some differences, of course, when it comes to both of those. A major one is going to be your rates. Because this is a DPA, rates are going to be significantly higher than a traditional FHA rate. I know someone will ask me, what is the rate? Unfortunately, on this particular call, I can't give that type of information, but of course, reach out to your account executive and they can give you the exact numbers. And we also have a quick pricer in our broker portal that you can run through scenarios for not just this program, but anything. And they'll be able to let you know what the current rate is for both the 2% and the 3%. The 3% usually skews a little higher than the 2%. That's kind of the major difference when it comes to them. The other difference is, of course, your FICO requirement. So the 2%, you can go down to a 620. For the 3.5%, the minimum would be a 640. Now, for both of those options, no matter which DPA you're going with, we do require an approve eligible findings through your DU. So, desktop underwriter is the only one we accept on this program, and we do need that approve eligible finding. So, we are unable to do a manual underwrite when it comes to the remarkable DPA specifically. So keep that in mind when you're kind of doing those initial setting up proper expectations with the partners you're working with on your end, when you're kind of structuring your transactions on the remarkable DPA, is that need for the approve eligible in order to proceed. Now, that also entails making sure that the grant itself is included in your AUS when you run it. So I have a slide in this presentation deck that shows you how to actually include it in your 1003 when you set it up. So that way it's set up properly. But make sure that that's included, because one thing that we have found in the past is that when you add the grant into your AUS, what that does is that desktop underwriter considers that an additional risk on that borrower. So it can take a borrower that's getting an approve eligible without the grant. And then once you add the grant in, it flips it over to a refer. So keep that in mind. That might be something you have to work with our team to kind of figure out how to maybe restructure some things so we have that true approve eligible with the grant included in there. Now, some other specifications to keep in mind. You could do either a 25 or 30-year fixed on these. It is purchase only since it's a DPA. Big one to keep in mind here is that it is borrower paid compensation only. So when you're setting these up, when you're running it through the pricing engine specifically, you have to select borrower paid compensation in order to show this product as an eligible product. The same thing applies, of course, once you actually register the loan with us and you're locking it. It needs to be set up as borrower paid in order for the remarkable DPA to become available to you. 96.5% max LTV, but if you're using the 3.5%, it covers the entire down payment option there. Otherwise, if you do the 2% DPA, borrower's just responsible for the remainder there, that 1.5%. Max DTI, basically anything that's under 50. So 49.99 is specifically the max DTI on this program. But as long as it's under 50, that's basically the rule of thumb there. No high balance loans. So there's not a specific dollar amount. I know a question I get a lot is there a specific dollar amount that the DPA will release? Is there a certain amount for the loan amount? All those things. So from the DPA grant itself, there's no specific cap. So there is no dollar cap on the actual DPA itself. But from a loan amount perspective, the loan amount can't be high balance. So we need to be under high balance in order to proceed. We talked about your approve eligible. We need that. And then for your property types, 1 to 2 unit primary residences. You can do manufactured homes, single wide, multi-wide, even in your condominium projects, as long as the condominium project itself has been FHA HRAP approved. So prior to the application of this particular loan, if the entire community is FHA approved, you're good to go under condos as well, if that pops up. And then your planned unit developments, your PUDs, PUDs, however you like to say it, those would be acceptable as well. The only piece to call out here specifically is that I'm not sure if anybody does business in that state, but if you do, the state of Washington specifically does not allow for this program. Now, that's because they have their own internal laws in that state that don't allow for DPAs that are from outside of that state. That's the reason for that. But if anybody here does business in the state of Washington, unfortunately, that particular state is not eligible for this particular program. And then just to kind of round out things, those initial parameters, right now the program is only allowed for a traditional 203B FHA purchase. So just a regular, straightforward purchase under FHA. It cannot be combined with any other type of FHA product. So you can't combine it with renovation or rehab. You cannot combine it with other DPAs. I've gotten that question before. Can you take the remarkable DPA and take, let's say, a county DPA from Florida and combine them together? Unfortunately, the answer is no. Our DPA can be the only DPA on that transaction. And then because of that approve eligible requirement, because we can't give any exceptions to that approve eligible, we do not allow for to be determined properties. Um, and that's because of that piece. We've noticed that, of course, when you kind of submit something as a TBD, you're kind of just making up numbers to try to see exactly where they're qualified. And then once you actually push that file forward and you put the real numbers in from your purchase contract and everything, that can drastically change the findings of what that is. And then you're trying to figure out, okay, how do I get that borrower qualified, which maybe they don't anymore based on the home that they're purchasing now. So because that to be determined properties are not allowed on this specific program. So we talked about kind of all those parameters. We talked about the different options available. That's FHA, completely forgivable grant from day one, no resale restrictions, no additional liens, none of that. We talked about, of course, FICO requirements. We talked about DTI, all that type of stuff. But there is one kind of major piece of borrower eligibility that I'm going to spend a little time talking about this, and that's why we kind of leave it for its own section here. And so this is where your starting point. So before you even get to the FICO, DTI, AUS, all that stuff, your borrower has to meet one of these four categories. So the great thing here, and I want everybody to remember, it's written here, but I always like kind of focus it because sometimes people think it's too good to be true, and they overcomplicate it. And I'm just letting you know now you don't have to overcomplicate it. It's as simple as that. Only one borrower on the loan has to meet one of these categories. So let's say you have a husband and wife. If the husband meets one of these categories, you're good to go. Now, both borrowers still need to meet your FICO requirements. They still need to fit within the other parameters we've talked about already. But from these categories, only one borrower has to do so. So let me talk about them in basics, and then we'll talk about some details. I'll give you some examples. So the first one here is first-time homebuyer. You could do it off of that. You could do it based on their employment or volunteer history. You could do it based on income, or you could do it based on just the home by itself if the home is in a underserved census tract. So that's not even the borrower. That's if the home they're purchasing is in an area that's considered underserved. That qualifies them for the program. Don't even need to worry about those other three categories. So that's a big one. The one that scares people sometimes is the income category because a majority, I would say 99% of DPAs have some type of income limit. Our program has absolutely zero income limits. There is no income limit at all in our program, with the exception on if you have to use that as a last resort. You've gone through every other option, and there's no other way to fit them into this program. We allow you to use that as a like absolute last resort to fit them in. So we give it there just as another option. But that's exactly what it is. Not a requirement, an option. So let's talk about each of these. The first one is first-time homebuyer. Pretty self-explanatory. So exactly as the name entails, they've never owned a home ever, or they've had no ownership in the last 3 years. So as long as they've either never owned a home or have had no ownership in the last 3 years, they're good to go. They are qualified to use this program on this category alone. So there we go. We fit that. So I'm talking to Mr. Smith. Mr. Smith he's rented, but he's never actually owned a home. Okay, he's qualified under this category. Now I just need to check he fits within all the other buckets. He fits within FICO, DTI, the prove eligible, all that stuff. We're good to go. But let's say, okay, I'm talking to Mr. Smith and he goes, no, I own a home right now. I just want to buy another. I want to move and move to a new primary residence. Okay, so then they don't fit this category. Let's keep going. Next one is based on employment or volunteer history. Now, this one is a fun category, as I like to say, because this is probably where the majority of people you talk to are probably going to fit in this program. And I'll explain why. So you'll see here on my slide there are subcategories. Now these subcategories are the hard and fast rule if you're going off of employment. So if you're going, whether that be that they're currently employed or they're retired, if you're doing employment, these subcategories, they have to be within these categories. However, if you are doing volunteer does these categories are just suggestions for the volunteer piece. Volunteer can be anything. So let me explain. Let's talk about employment first. So for employment, it has to be either somebody military personnel. That could be a service member, or it can even be a civilian that works, let's say, on a military base. That still it fits within that bucket. First responder can be police, firefighter, public safety officer, EMT, all of that. Educators, traditional K through 12 teachers, college professors, Sunday school teachers, tutors, uh, daycare providers. Medical personnel can be a nurse or a doctor, but it can also be the lady who checks you in when you go for your doctor's appointment at the front desk. That fits within medical personnel. And then civil servant, anybody who works for either a federal, state, local municipality, working at the DMV, something like that, or post office. That would fit within civil servant as well. So those are for your employment. Now we can use those as kind of a starting point for volunteer, but volunteer can also be anybody who has a child has probably at some point, once they're school age, has probably at some point volunteered at their child's school event. I had somebody the other day who was a little league coach. He volunteers as a little league coach. They're qualified to use this program because they're a little league coach. There can be they have them here called it like a tricky tray. Those like a raffle that a school does to raise money, a fundraiser. If you volunteer at those type of events for your child's school, you're qualified to use this program on that alone. Um, Another example I want to give is if throughout the year they have these walks that raise money for different diseases. Like in October, they raise money for breast cancer awareness. If you signed up for one of those walks or one of those fundraisers, you are qualified to use the Remarkable DPA on that alone. Now, next question I'm going to get is, what does the underwriter need in order to document said volunteer work? And the answer is nothing. It's as simple as that. All we ask is that there is an application that's part of the DPA. If this is the category the borrower fits, they check off this category, they sign and date that application, and there is nothing additional needed at all. So no additional paperwork. And they can have volunteered either yesterday or they could have volunteered 10 years ago, and they are still qualified to use the Remarkable DPA because they volunteered at some point in their life with no additional documentation required. It's as simple as that. So that's why I say most people you'll speak to probably fit this category, and this is going to be the reason you're going to use the Remarkable DPA under. Either this or that first-time homebuyer one that I showed you earlier. So those first two categories, those are the most popular, and those are the ones we usually see the most people use when it comes to this specific program. Now, okay, I'm talking to Mr. Smith still. I've jumped to this category because he's not a first-time homebuyer. Mr. Smith has never worked in any of these jobs in any capacity, and for some reason, Mr. Smith has stayed home and he has never volunteered at any point in his life. He doesn't have kids, never volunteered at anything. Okay, Mr. Smith, we haven't fit the first two categories. Let's move to category number 3. Here's where that income comes in. And like I said, income is not required on this program unless we have to use this as a last resort. If we do have to use the collective income of everyone that's on the loan application. So if there is more than one borrower, then if we're using the income specific category, we do need to use their collective income here. And it has to be equal to or less than 140% of the state or county median income. Fannie Mae AMI lookup tool, and we use that tool to do the calculation, figure out what 140% is of that local median income, and then that will be your cap. That's the most that those borrowers collectively can make in order to qualify under this specific category. But like I said, we just give you this as an option if you absolutely need it. Otherwise, don't worry about this category at all. Kind of just have it off to the side as a backup if we need it, but otherwise, this is just there as an option. And then the last one here is based on just squarely the home that they're purchasing. If the home that they're purchasing is in a underserved census tract, they can use the program just on that. So we don't even need to worry about those other categories I just talked about. The home itself qualifies them to use the remarkable DPA. So basically, these four categories, like I mentioned, they are designed to cast as wide of a net as possible to fit pretty much most people you could pull off the street. This is your starting point. The first, you ask some questions to say, okay, do you fit within any of these four categories? Awesome, you fit within first-time homebuyer. So now that we fit within that category, next step is let's check the FICO. Let's check your DTI. Let's make sure we get the approved eligible with the grant included in the AUS. Let's make sure we fit within all those other buckets. And now we're good to go. It's straightforward and as easy as that. And like I said, our goal here at MLB, our main mission, of course, every day is making lives better. And that's what this program is designed specifically for, to help as many people and do that for as many people as possible. So moving forward, some just things to call out. Like I mentioned before, it's not available in the state of Washington. But if anybody here does business in the state of Wisconsin, on top of the DPA, they actually get a credit of up to $700 for the appraisal. So that's only if they're buying a property in the state of Wisconsin. That's just something extra to get for that specific state. So if you do business there, you can let them know, hey, you're going to get a up to 3.5% DPA if you use that full option. And you'll also get a credit on your closing disclosure for up to $700 for your appraisal because you're purchasing a property in Wisconsin. So just something extra for that particular state. I mentioned earlier there are some additional documentation needed for this program. The great thing is it's 3 documents and it doesn't put any type of wrench or hold on the process. MLB, we are the administrators for this DPA. So everything is done 100% through us. So you don't need to worry about going through third-party vendors. You don't have to go to a separate website. You don't need to wait for us to send it to another underwriter outside of MLB for them to do a complete separate underwrite. Lots of other DPAs require all these additional steps that take a process that can take uh, traditionally something that can take like 15 to 30 days to close an FHA loan, maybe even less than that if you have everything. You could take that and then it's on a regular DPA, it can spread that out to 60 days or plus on most DPAs. Our program, it's just a regular FHA. You don't need to worry about extended turn times. You don't need to worry about having to communicate with third-party vendors. Everything is done 100% with our team members just here at MLB. And what will happen here is that you go ahead, you register that loan with us, you submit it to us, get disclosures done, you get all that stuff done. Make sure you select the Remarkable DPA as your program that you're looking to use. And then when you get your initial underwriting decision, your underwriting approval, the account manager on our side will provide you with these 3 documents. Once the account manager provides those to you, then you can get them over to the borrower to make sure they can sign and date those documents, acknowledge them, all that stuff. So that includes the application, which is where those 4 categories come into play. The borrower picks which one they fit within. The grant letter, which will have the actual dollar amount of what they're going to receive at closing. And then the program/consumer disclosures, which just breaks down that they understand they're using a DPA as part of their FHA loan. They understand by using a DPA, it comes with a higher rate compared to a regular FHA loan. Just kind of the base, and also let them know it is a forgivable grant. They're not expected to pay money back or any of that type of stuff. So it's just those 3 additional documents. Otherwise, you're going to provide all the same regular things you're used to on a regular FHA purchase without any other headaches or hoops that you have to jump through. One piece I want to call out, some additional things. On the 2% DPA, MLB does not charge an underwriting fee. So we completely waive that underwriting fee on the 2% DPA. On the 3.5, we lower that down to $5.95. So traditionally, it's $14.95 is our traditional underwriting fee. But like I said, completely waived. MLB will be the one who actually pays for it on the 2%. And then the 3.5%, it is lowered to $5.95. So just kind of setting this up in a better position for the borrowers that need this assistance. This is something, if anybody here has worked in it with a DPA before, you know it's traditional that they have to take a home buyer counseling class. Now, all we require, we don't have a specific class they have to take. It just has to be run by a HUD counselor. So as long as you have a class that's run by a HUD counselor, you can go ahead and use that. And only one borrower has to take the class. So if there's more than one borrower, like I said before, if there's a husband and wife, let's say, if the husband takes the class or the wife takes the class, as long as one of them does it, that's acceptable. We give you some examples of classes we can accept. The Fannie Mae framework class, it's Fannie Mae, but it's actually run by a HUD counselor. You have CFPB has classes. Even HUD's website, you can find classes on there. So we include, you probably have seen links on these different pages I've shown you today. We're going to send everybody here on the call a follow-up with a direct link to all these presentation slides. So you can always, of course, use this all as a reference tool. And we do have these on our MLBwholesale.com website as well, 24/7. So you can always circle back around too. So you don't have to worry about remembering all these links and stuff right now. We will provide you with those additional tools. But the great thing is about this class is, like I said, only one person has to take it. It has to be run by a HUD counselor. It can go through any agency as long as that's the factor there. And MLB will actually give a lender credit up to $100 for the cost of that class that will show on the closing disclosure. So what we ask for, one of the things we'll condition for, is for the invoice and the certification of completion of that class. And then so that way our team knows how much that class was. So for example, the framework class is usually about $75. So if the class was $75, there will be a $75 lender credit going back to the borrower on their closing disclosure for that class. Like I said, the maximum that we can give is 100, but traditionally most classes are about 75 or maybe even some are 50, or there actually are free ones out there. As long as it is a HUD counselor running it, we can take a look at that and accept that as well. So just keep that big piece there in mind. Here's what I mentioned earlier, that if you have a borrower buying a property in the state of Wisconsin, they get that lender credit of 700 up to $700 as well. That goes towards the cost of the appraisal. And then, like I mentioned, we're going to follow up with everybody who joined today with the slides. So you don't need to worry about writing this all down right now, but we do have instructions how to properly register this particular program in our portal. When you go ahead and register the program in the broker portal, all you have to do is you register it just as regular FHA, what you guys are used to right now, nothing crazy. You don't need to do anything with the 3.4 file or anything like that. But once you go ahead and actually upload it, you do need to go into your IRLA 2020, go in your 1003 basically. Then you're going to go to loan and property information. That's the gifts or grants you have been given or will receive section. And once you're in there, there is where you're going to actually enter in the details of the grant. So that way, when the AUS is run, it has that information in there correctly. So it will give you the right results. So big thing here, financial institution listed as PFA. PFA is a government agency. They're the ones who are actually providing the funds for this program. Like I mentioned, MLB is the administrator. Everything's done 100% through us. PFA, all they're doing is just delivering the funds to the closing table once the loan has been issued at clear to close. So you don't need to worry about, you're not communicating with anybody outside of MLB. And like I mentioned, there is no cap on the funds that are being provided, and there is no time limit set. A lot of other programs are like, oh, we only have from March to November. There is no cap on the dollar, and there's no cap on the time. So it's just open, completely open with no sign of any types of caps ever coming in the near future. So keep that in mind. Asset type is a cash gift that is not deposited since it's not actually sent until we get a clear to close. It's from a federal agency, and then your cash or market value is going to be which option of the DPA you selected, whether you did the 2% or the 3.5% option. So it's either 2% or 3.5% of the purchase price. So make sure you enter in all of that correctly there. It's going to be the same every time. The only thing that will change, of course, is the dollar amount. And then click save. so that you save it into the loan file there in our broker portal. And that's all you need to do from your end. Once you have all that done, the next thing that you'll need to do is once you get an underwriting decision, our account manager will give you those three documents so you can go ahead and get them signed by the borrower, then return it to us the same way you would any other document. And it's as simple as that. The only additional time frame, because we have to request those funds once we get a clear to close, keep in mind that the funds are only released 3 times a week. So beginning, middle, and end of the week. And those funds are only released early in the morning for each of those days. So because of that, we do need 48 hours for a closing to be scheduled once you get a clear to close. So, but that's the only additional time frame. Otherwise, what our normal turn times are for underwriting, for response time, everything else is exactly the same. You can get one of these if you go ahead and submit everything to us as quickly as possible. You have all of your pieces for your borrower. These are extremely easy and quick to move through from beginning to end because you're just doing a regular FHA purchase loan when it comes to that. So nice and simple. Now, before I wrap things up, I do want to call out here real quick. We throw it in this presentation. Um, if you have joined us before on a webinar when we've talked about our Green Advantage program, or if you haven't, I'm going to just call out here. I highly recommend you join us on one of those. I call out this program because the Green Advantage is not a DPA. It is not a down payment assistance. However, it is kind of a uh, maybe a cousin to the Remarkable DPA is kind of the best way to put it, because it's another program that provides borrower assistance. But the difference here is that whereas the Remarkable DPA provides a grant that's used only for DPA, Green Advantage provides funds up to $13,000 that the borrower can use for anything. So that does include DPA, that does include down payment, but it also includes closing costs. It includes paying off any debts, that includes any reserves, or the borrower has the option of depositing that money into their personal account and going off and doing whatever they want with that money. It's their money when it comes to the Green Advantage option there. Um, on top of that assistance, they're getting brand new solar panels installed onto the home, whether that be a purchase or a rate and term refinance on this. Now, people shudder when they hear the word solar panels, but I got to explain here is that this is using the FHA Solar and Wind Technology Program. So because of that, the solar panels are financed into the FHA loan. So there are no additional liens. There are no UCC filings. So the borrower owns everything 100% in their name from day one without any of those additional headaches and restrictions that come with traditional solar panels. The solar panels are really kind of an extra thing to support long-term affordability and savings for that borrower. The main focus of the Green Advantage is really that borrower money that they get that gets deposited into a personal savings club account in the borrower's name by the company Hoper. Hoper is the partner we work with. They're the ones that actually provides the funds. They're the ones that do education with the borrower directly in order for the borrower to be eligible to get the funds. And it kind of goes from there. I only bring up this program, like I said, because it kind of works as a different option. If the Remarkable DPA just doesn't fit your borrower because the rate doesn't work or the way it's structured doesn't work, Green Advantage is another thing to think about and say, okay, this might be a good option for me in order to fit my borrower into something that will help them, give them that little extra assistance if they need that little extra assistance from there. So some frequently asked questions here I'll throw up on the screen. Once I'm done with these, if you guys have any additional questions, feel free to throw those into the chat box. But I'm just going to go through some of these as we wrap things up. Does the program allow for non-occupant co-borrowers? So yes, it does allow that. We follow regular HUD guidelines on non-occupant co-borrowers. As I mentioned earlier, only one borrower has to meet one of those 4 categories in order for us to proceed. To be determined properties are not permitted on this specific program. Do we need confirmation of wire instructions prior to DPA fund disbursement? The answer is yes, because we want to make sure that once we get that clear to close, that our team can go ahead and request those funds from the agency that provides the DPA funds so they can get to the title company, the settlement agent, as quickly as possible so we don't have any holdups on scheduling that closing. Will there be any additional liens? No. Like I mentioned, it's a grant forgivable from day one here on the Remarkable DPA. And then if a borrower has previously completed a homebuyer class, can we accept it? Yes, we can, as long as it was run by a HUD counselor, and as long as the course doesn't expire prior to the note date. So some of them have expiration, some of them don't, but it needs to be there. Do all borrowers need to take the class? No, only one has to. The borrower is more than welcome to put down as much money towards the transaction as they are comfortable or able to do so. But remember that this program only provides up to 3.5% in that grant towards the down payment. Are the DPA funds taxable? Somebody asked me this question before. The answer is no, because they actually come from tax exempt bonds. Um, and then you have, are there additional documents required? Yes, there are three additional documents. There are those three that will be provided to you by our team. So the account manager on our end will give those to you once you get your initial underwriting decision. So those are the basics of the Remarkable DPA. I saw a couple questions come in here. I'll circle back around to. Those are kind of the basics there. Of course, I'm going to go through and answer some questions here. But if you guys think of anything after today's call, reach out to your assigned account executive. Let them know what questions you have. They're more than welcome, more than happy, I should say, to walk you through not just this program, but any of the programs we have, how our portal works, how to be comfortable, and as I always like to say, comfortable and confident on how to jump in there into the system. So let me circle back around to some of these questions we have here. I'll answer some of these since I brought it up. There's a couple questions about Green Advantage. So let's circle back around to that for a moment. I'm actually going to bring this screen back up here. So where is the cost of Green Advantage included? So the way this works is that the cost of solar is financed on top of your base loan amount. So your base loan amount is calculated the same, 96.5%, and then you're going to put the cost of the solar on top of that. So the max LTV on the Green Advantage is going to be 120%. So you can go up to 120% on the Green Advantage because you're adding the cost of solar on top of your base loan amount. But it gets financed all in just to that FHA loan there altogether. Does the Green Advantage program have a higher rate as well? So that's a good question, because the other reason why I bring up Green Advantage is because the Remarkable DPA always has that higher rate, no matter which option you go with. Green Advantage is going to be more in line with traditional FHA rates. So there are really not that much of a difference between the Green Advantage and just your straightforward regular FHA loan. So that's a major difference too between Remarkable and Green Advantage is they both provide borrower assistance, but one has that higher rate and one provides the assistance through our partners at Hoper, but is a little bit more in line with traditional kind of FHA limits there. Um, First, so actually jumping back here, I'm going to finish a couple questions about Green Advantage and I'll jump back to Remarkable here. Somebody asked a question about, is Green Advantage available for VA? The answer is no. Green Advantage is only for FHA. So both of these programs, both the Remarkable and the Green Advantage, both of those are FHA only products. If you have any questions about how to get your credentials to log into our portal, reach out to your account executive. If you don't have your account executive's information, what you could do is you can reach out to our client services team. I threw our client services email into our chat box here. That's an email that anybody, of course, can use for additional help. But yeah, that client services team will be able to assist you if you don't have the information for your AE or you can't get a hold of them. We can point you in the right direction there as well. But reach out to the team and we'll get you in the right place to get your credentials. I want to jump back to Remarkable for a second here. So for the Remarkable DPA, somebody asked a question, is the first-time homebuyer still need to meet the income thresholds? No. So remember, you only need to meet one category in order to use the program. So if they're a first-time homebuyer, no income limits at all. So absolutely zero income limits if they're a first-time homebuyer. So that income only comes into play if you have to use it. It is not a requirement. Okay, question here was, so there was a question about the DTI for the Green Advantage. Jumping back to that, so we're jumping between two programs here today. Um, for the Green Advantage, it does have a. We would follow traditional kind of AUS when it comes to that as well. That program also needs an approve eligible findings in order for us to proceed. So we that DTI is traditionally kind of where it gets a little tricky on the Green Advantage because you're raising that LTV over the 96.5. But if you want to kind of work with our team, if we run into a situation where the DTI kind of goes over limits, we can kind of see where the numbers kind of go from there on Green Advantage specifically. And then the question here is, can you explain the 13,000 for the Green Advantage? Okay, so the way that works is that, like I said, that money is provided by Hoper, Hoper. They are the partner that we are working with. What they do is that at the same time as we here at MLB are working on the purchase of this brand new FHA loan, when it comes to the Green Advantage, the borrower at the same time is working directly with Hoper. They are taking a home buyer education class with Hoper. Once they complete that course, what Hoper does is they open up a personal savings club account in the borrower's name. They deposit that money into that savings club account, and the underwriter looks at that as earned income. So Hoper provides a 1099 document. They provide additional financial documentation so that the underwriter has all the requirements they need from an FHA standpoint. At the closing table, the borrower has the choice of where that money goes. They can use that money for the down payment if they want. Excuse me. They can use that towards closing costs. They can use it towards paying off debts, towards their reserve requirements if they need that. Or the borrower, because it's in their name and it's their money, they can deposit that money into their own separate bank account and do whatever they want with it. That's it. It's as simple as that. They can use it towards the loan or they can use that money towards any amount. Now, 13,000 is the cap. There are dependent on certain factors, depending on where the home is located, the size of the home, the purchase price, different factors will determine if they get the full 13,000 or maybe they get less than that. But Hoper is the one who actually they have their own proprietary calculator internally that they go ahead and do those calculations working with you as the loan officer and working with the borrower to kind of break that all down on the reasons why everything kind of fits where it fits. And then back to Remarkable. I know we're jumping around here. Back to the Remarkable. Um, the household income, if they have to use the household income, like I said, that's the last resort. If we have to use household income, it is just loan applicant. So it's not everybody in the house. It's just whoever is on the actual loan application. And then for Green Advantage, do the homeowners decide on the contractor for the panel? So the way it works is that Hoper has a list of contractors that are approved through them. The borrower will then choose from that list. So it does need to go through Hoper. So both the funds and the solar piece goes through Hoper, but Hoper has a list of contractors that are approved in each state that they currently do business in. And then the borrower can choose from that list of contractors that Hoper has already pre-approved. All right. I know I got everybody excited talking about two different programs on today's presentation here. But if you guys have any additional questions in relation to the remarkable down payment assistance, let me know. Like I said, you can either throw those questions there in the chat box as we've been doing. If you feel comfortable, you can unmute yourself as well if you like. But otherwise, I threw our client services email right there in the chat box. The phone number here on my screen is also going to our client services team as well. Your account executive should always be the first one to reach out to, but if you do need that extra assistance, that's exactly what our client services team was created for, is giving that little extra assistance if you can't reach somebody or you just need help. You just need to raise your hand and say, hey, I need that help to move on to the next thing. So in those questions, over there. If for credit score, if you're referring back to Green Advantage, it is 620. So 620 minimum for the Green Advantage. And the great thing here is that if you go to our website and you go to our resources page, I actually want to pull up for you guys. I'm going to throw that chat in our box here too. Um, There we go. So I threw that link in our chat as well. That goes to our videos and presentations. You can actually find the presentation slides for not just what I went through today, but for the Green Advantage. So it goes more in depth on how that program works. And it also goes to our YouTube channel, which we have all of those recordings in there. So it kind of goes through all those steps and pieces. So question here. I know everybody's excited about Green Advantage now. So question, how is in what stage does the cost of solar installation determined? Is there a lifetime warranty on the solar system? So the cost of solar is determined in the beginning. So that's one of the first things you do. You do that before you even submit the loan to MLB. So we actually cannot accept that file until we have the initial bid for the solar at the time of when you register that loan with us on the Green Advantage specifically. Hoper, like I mentioned, all this is done 100% through our partner Hoper. You're communicating with them, working with them directly. They are communicating with both the LO and the borrower. They have their proprietary calculator on their end. They calculate what the all-in cost is going to be. And then they provide an eligibility letter to the borrower saying, here's how much of assistance you're going to get. Here's how much that solar is going to cost. This is the letter that you upload when you register the loan with MLB. Then when our team receives it, we use that eligibility letter as the numbers that we're going to put into the file in order to kind of move from there. Now, of course, this is not a renovation loan, but similar to renovation, the numbers, it's possible the numbers could change after that initial bid. And if it does, Hoper is going to be once again the one that provides that updated information. You just provide our team with the information from there, and then we'll adjust those numbers similar to like a 2-3K, for example. Is that if that happens, and make sure we have all the right numbers before we actually close the loan. And then, yeah, there's a lifetime warranty on these solar systems because once again, Hoper is working with solar contractors that they've approved across the entire United States. There's only a few states that we can't accept this in. We can't do the program in the Dakotas, so North and South Dakota, Vermont, Massachusetts, and then Hawaii. So out of those states, oh, and Alaska as well. So those are the only states we cannot do it, but otherwise it's available in the rest of the United States. And there's at least one contractor in each state that's approved to do this particular program from there. So from that perspective, if you have somebody asked a question about hurricane repair replacements. So the Green Advantage only allows for a brand new solar system, so it does not finance any repairs to existing units. So the Green Advantage will only be for a completely brand new units from scratch. If that's something that they're interested in doing, that is possible because you can do a rate and term refinance on Green Advantage. It's not just for purchases. So if they're able to do that, a brand new, completely from scratch unit, that's acceptable on Green Advantage, but otherwise, the program does not allow for like repair or anything that has to do with existing type of units. Yeah, and I highly recommend what we'll do is that I'll have our team, our marketing team will send out, keep an eye out on our website for our upcoming webinars. We do have one dedicated to Green Advantage later this month. So for those of you on here that are super excited about the Green Advantage program, I highly recommend jumping on that webinar. Keep an eye out for it. And join us there. We'll go through all the bits and pieces and how the program works specifically, and we'll have a lot more time to kind of dedicate towards that program itself. But thank you for joining us on our presentation about the remarkable down payment assistance. Like I said, both of these options are fantastic items to have in your toolkit, your back pocket when it comes to your FHA borrowers. Like I said, reach out to your AE if you have any additional questions. Reach out to our client services team as well. We're always happy to help you. But once again, thank you so much for your partnership. And thank you every single day for helping us reach our mission of making lives better. Have a wonderful rest of your day, everyone.